John, I want to get your take on a couple of different areas of the market and also, stock ideas. But I want to first start with the Canadian banks because it was interesting to see them report, and when they reported an increase in their loan loss reserves, which was met by mixed reaction from a stock perspective. You would also think that in a rising rate environment, that the banks would be earning more money, and that could help propel the stocks higher. But there seems to be this overhang of concerns about their mortgages and, again, how the consumer will fare. How are you reading the results we saw from the Canadian banks?
Yeah, Catherine. I mean, don't have any Canadian banks in the portfolio right now, which is sort of rare. We sort of sold them a couple of months ago, and it's not that I have massive worries about downside for the banks from these levels. I just don't see a lot of upside. I think this last quarter sort of showed you that. I mean, a lot of what the tailwinds they had for earnings in the past 2 years are turning into headwinds. Like certainly they were taking loan loss provisions, excess loan loss provisions back into income statements. They're not doing that. They're increasing their loan loss provisions. And with an economic slowdown, those probably will increase further. Obviously, with stock markets, financial markets in general, rolling over, their capital markets activities have gone dramatically downwards. Underwritings have gone down. Trading has gone down. So, those are all problems. Yeah, there's probably a bit more of a benefit from the structure of the yield curve right now, as you say, because banks tend to borrow short and lend a little bit long. But I mean, with the curve inverting, that's sort of going to go in their face a little bit too, and they don't have the same interest rate sensitivity that they had in the past. So what it all adds up to is, yeah, I don't worry there's massive downside for them, and you're still going to get your dividend yield from them. But I just don't think there's much short-term upside. And then with TD and BMO, they've got to sort of bring in pretty big U.S. acquisitions over the next year or so, and there's always risk with doing that as well. So I'd probably gravitate towards Bank of Nova Scotia, Commerce a little bit more at these stage, where some of the risks have been taken out and the valuations are lower. But as I said, right now there's other areas of the market where I think there's probably better upside if we get a bounce.
What other areas within the Canadian market do you think offer better opportunities?
Well, I still think you want to stick with the energy trade. I mean, we're getting a little late, and it always bothers me that now, with 2 years ago, people wouldn't touch energy. Now everybody comes on and they say, that's the only sector, and you got to believe in it right now. It's a lot of money is piling in, and I don't sort of like that, but it's hard to argue with the valuation. When you talk about 20-25% free cash flow yields trading at 3 times operating cash flow, and I just don't really see a break in the oil price coming forward in the short term, even though it's come off the boil a little bit recently. I mean, the U.S. has sort of used up the SPR. China's coming back on with more demand. You haven't settled any of the problems with Russia and Ukraine right now, and there is somewhat of a fundamental, shortage in the supply of oil. So that's going to keep prices in these range. And these companies kick out a lot of cash at those levels. So I'm more into the oil levered companies. Where it's probably a little bit more cautious short term is natural gas. I mean, there's really in North America, there's no fundamental shortage of natural gas. There's problem of obviously getting it to Europe right now. We don't have the access to, the pipelines or the LNG facilities really to move it to those markets, so we can never benefit from it. And you still could, kick off a lot of excess gas in shale production and other things. So it's, I don't think gas prices are going to sustain anywhere near where they are. So, the pure gas levered companies like Tourmaline to a degree, ARC, Birchcliff, Pado, I'd be a little bit more reticent on those as opposed to the oil levered companies like, Cenovus, Suncor, Crescent Point, Whitecap, names like those.
hmm Yeah, it's interesting. I do feel that even though we've seen the price of WTI pull back quite dramatically, the fundamental structural reason to still be long oil to me is still very much there. And it's interesting to see the new UK Prime Minister lift the ban on fracking today.
Yeah, those supply constraints are going out the window in the short term to get these supplies in, and they're doing everything they can. And in the end, you're getting a better response. And but like then in the short term, with demand probably coming back from China now, and no resolution anywhere in sight in Ukraine. Yeah, it's still going to be squeezed for a period of time. And while it does, these guys kick a lot of excess cash that they are suddenly more shareholder friendly about, and handing back, whether it's through buybacks or increased dividends or whatever.
Yeah, a couple of special dividends. So still go long Synovus in Canada, maybe lighten up on some of the gassier names here. We're going to take a quick break, and when we come back, we're going to get a few more stock ideas from John Zechner, and specifically perhaps a couple of U.S. ideas. We'll be right back.